Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
It is the start of another important week in finance. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Is this week going to be the climax? Or is this the anticlimax? No, I'm not talking about movies that are coming out this week. I'm referring to the FOMC meeting this Tuesday and Wednesday. Are we going to hear more surprising news during the press conference? Or have we already experienced the peak shock wave from the higher than expected US CPI print last week? Well, currently, a 75 bips rate hike is very, very much priced into risky assets. And the probability of a 100 bips rate hike has been coming down gradually from close to 40% right after the CPI print to the current 20%. What the Fed says in their press conference is thus going to be extremely important. Now, of course, if you look at risky assets, they are already very fragile, with S&P 500 breaking below the 3,900 support level on Friday, after flirting with that level for most of last week. We believe the Fed is likely to reiterate that their actions will be data dependent and may refrain from making very definitive statements. Once again, we continue to see the importance of having a barbell approach, and you should be balancing a portfolio with both income and growth exposure through rotating into assets such as high dividend equities and DMIG corporate bonds, those we've talked about last week. Now, I want to give you a bit of additional information here. For high dividend equities, so far this year, US equities have been the outperformer. Year to date, US high dividend equities have outperformed global high dividend equities by roughly 5%. The key point to note is that the risk of dividend cut in US high dividend equities is seen to be relatively lower than the other regions. Now, in terms of DMIG corporate bonds, we believe bonds with neutral duration, i.e. about 5 to 7 years, offers the best risk and return trade-off. So first of all, the yield gap between the shorter and longer duration bonds is already not so significant. And then you look at growth expectations. Basically, the Fed tightening may worsen the growth outlook to the point where the Fed policies turn less hawkish in the future. Additionally, an inflation peak in the second half of 2022 against the backdrop of easing supply chain disruption could support expectations that the Fed end up with more room to cut in order to support growth. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.